The information contained in this podcast is not financial nor investment advice. All trades and investments are my own. All opinions are my own and should not be construed as advice. If you do decide to trade or invest in any of the markets discussed, you do so at your own risk. Welcome to the 15th episode of the Blockchain Immersive Podcast. And I have to tell you, it's only Wednesday, September 21st, and there is already so much going on, and that's why I decided to start now. But technically, the Trader's Corner, which will be towards the end of this podcast, only because it's so long, I started recording that on Saturday and Sunday, because there were some trades that obviously were not included in the previous podcast, and there were some pretty good ones, and the market is so active right now. So this is what we're going to do. We're going to go through some news, breaking news that came in, and then I'm going to discuss what I said last week. I was going to give you sort of an overview of options, and then I was going to discuss and show you a site that gives sort of like these alternative statistics for the economy, and it's definitely worth looking into. And then at the end, I'm going to do Trader's Corner instead of in the middle, because it's about 20 minutes long, and it's a series of videos of my trades as I was trading throughout the latter part of the weekend and early part of the week, and I'm actually still in a trade right now. So anyway, let's get to the news. So in the American Banker, which is a trade journal for American bankers, some interesting articles popped up in the online edition. And here's the first headline is, what's still missing from crypto payments? And it says here, despite the market fluctuations, digital assets such as stablecoins are gaining ground as a point of sale option, but there's still a lot of work to be done. Now, that's really important, because what the banks are saying is that they are looking to get into the crypto market as payment processors. I mean, that's exactly what they're saying. And remember what I told you, that the smart investors, the smart monies, are looking at the markets now while they're down, whereas the public is long asleep. And that's really unfortunate. And that's why my courses at blockchainimmersive.com will help you sort of wake up to this before you miss out on the next opportunity. So the next headline is fitting NFTs into financial services. And it says here, the use cases for non-fungible tokens for consumer loyalty, gaming, and other business purposes are expanding. And while banks and payment companies step up their NFT experiments. I mean, this is huge. This is absolutely huge. So now the big financial services are like, wow, this is the time. And then we have this one here, why crypto users are coming to credit unions. So a lot of crypto enthusiasts and buyers are going to credit union now to experience cryptocurrencies, to buy them, to sell them, and credit unions are responding to that. Now, the next big piece of news, I mean, this is probably the largest piece of news this week, is the merge, the Ethereum merge. And I'm not sure if you've heard this or not, but the merge is essentially an upgrade to Ethereum. And basically what it did was it changed the way the transactions are processed. And it's a huge upgrade. And essentially they kicked the miners to the side and created a new way of processing the transactions. I'm not going to get into the nitty-gritty about that because it's a little bit more complex. But the benefit here is that, one, Ethereum becomes easier to transact and hopefully lower fees, but also because it's not using the same mining capacity as before, the electricity consumption drops. And according to what I've read, 99.9% decline in Ethereum's energy use. That's huge. So as you can see in this headline, did the Ethereum merge drop worldwide electricity consumption by 0.2%. I mean, that's incredible, absolutely incredible. So the merge is overall a good thing. And again, look at when it's happening. Look at when all of these things are happening. It's happening during the market's decline. Again, smart investors, smart people are looking into these markets now while they're depressed. Next is, this is TechCrunch, and it says here, Y Combinator is doubling down on crypto founders despite market volatility. Now, what does this mean? Y Combinator is an incubator for tech companies, and they have a very good track record of investing in companies that inevitably end up doing pretty well. And so this is huge that Y Combinator is doubling down on it because look, again, the smart people are getting in, are looking into this market even more. And that's why I'm so eager, and I've been saying this for the last 2 years. I mean, if you haven't learned about cryptocurrencies, now's the time, really. I mean, it's a great industry to be in. The next big piece of news that came out was this. Schwab, Citadel Securities, Fidelity, and other Wall Street firms start crypto exchange EDX markets. This is huge because, as you can see, they are now fully backing cryptocurrency. So this means that it's not going away. It's not going away. Cryptocurrencies are not going away. The big guys have finally woken up to what we've already known. Now, this is a double-edged sword, right? Because part of the reason why cryptocurrencies were so alluring is because the big guys weren't in it. But now that they are, this pushes innovation in this space. And because they have such deep pockets, it's very unlikely that the government is going to ban them. So again, a perfect time to learn about cryptocurrencies. And the next piece of news, it's Blockchain Association sets up new crypto industry PAC, or Political Action Committee. And this is, again, a huge thing. So now, because of widespread adoption of cryptocurrencies and blockchain technology, they're now going to have a huge say in the way legislature is brought to the, how it passes. And that's really big because that means that, again, cryptocurrencies are becoming a staple of the economy. And again, we have prices that are really depressed now. So this is really the time to look into them. And finally, this piece of news, Fed raises rates by another 0.75 percentage point, pledges more hikes to fight inflation. As I said in the previous podcast, I think that they're just making a huge mistake here because they're just using an old tool for a problem that is completely different from the problems that they used this tool on before. So all this is going to do is going to cause pain at the bank when people want to take mortgages, which, by the way, has new home sales have dropped, and prices are dropping as well. So this is, I don't think it's actually good for the economy for them to do this. But again, I'm not an economist. But if you look deeply at what's going on, you'll see that it's not the best solution in the world. Okay. That's just my opinion. So as you can see, they're big news, and this news actually is helping a trade of mine that I did record my entry in. You'll see it at the end of this podcast. So the next thing I wanted to show you is a website that sort of supplies statistics that are not, that let's just put the accepted economic forces don't necessarily agree with it. And the name of that site, I will bring it right here. is shadowstats.com. Now, I'm not affiliated with them, but I do have a subscription. Now, what's interesting about this site is that the person who created it is reimagining the numbers that are coming in from the government because and making it more honest, because the government, and I hate to use the term just, the government, but the powers that be who pull the strings of the economy, when they release statistics, it's not exactly honest. It's like they take some stuff out, put some stuff in, and that's just, ridiculous. So the numbers that you see are not always honest. And so this site has some very good information. You need to be a member of the site. But just to give you an idea, if you look here, there's two different ways of measuring consumer inflation. You have based on the 1990 method and 1980 method. And if you see the official inflation is around 8-something%. You have here, again, around 8%. But he calculated that it's actually closer to, it looks like 17%, if not more, 17%. Now, to be honest, that makes sense, right? I mean, when we go to the stores and to buy our food and everything, it doesn't feel like it was an 8% increase, was it? No, it feels much worse. And this might even be conservative. In some cases, we're experiencing 25-30% increase in food. So I tend to like shadowstats.com because it keeps the numbers more honest. And just one more thing to show you from this site is that the money supply, too, he shows that it's increasing by an astronomical amount, which we already know is happening because they're always pumping new money into the system. So definitely look at shadowstats.com. I think that's a really interesting website, and it'll give you a more honest look at really what's happening in the economy, especially the U.S. economy. And I think you'll probably agree with his CPI and inflation numbers, because that's what we're actually feeling. That little downtick that we had with the last podcast, that was due to gasoline, but everything else went up. So gasoline prices went down, and to me, that's just normal market rhythm. Because when markets shoot up like they have, you are going to expect some type of correction. So I don't know. I think inflation is still pretty high. Just because gasoline was down, clearly nothing else was. So check out shadowstats.com. I think you'll like it. Now, the next portion of this podcast, I'm going to discuss options. Okay, and a lot of people ask me, what are options? And it's a very complicated topic. So what I'm going to do is I'm going to explain options in light of the stock market. And the reason why is because, one, that is a very high volume options market. And it'll just be easier to explain, because if I use like commodity options, it's not going to be easy because most people aren't trading commodities, don't know a lot about them. So if I all of a sudden say, and the 4-cent call, you're going to be like, well, what do you mean 4 cents? So I am going to show you what options are and how they're used in the stock market. And I do hope you enjoyed. I recorded it separately, so I'm going to cut this off right now and go right into the options. See you there. Welcome to this quick tutorial on options. So options are complex instruments, and I will just give you the basics so you just sort of get a feel for them. So an options contract is a derivative instrument, which means its value is derived from another asset. In these examples, we will discuss options on Amazon.com, on their shares. Now, there are many kinds of derivative products across many different markets, and options are just one of these derivative products. I mean, there's tons and tons of them. In fact, there was a subgroup of derivative products that actually brought the economy down in 2008 in the mortgage crisis, but we won't get into that now. So, an option buyer has the right to either buy or sell a stock, in this case Amazon, at a predetermined price at some point in the future. The sellers of these contracts charge what they call a premium in return for this privilege. If the market moves against the option buyer, eventually the option will expire worthless and they lose their initial investment. If the market moves in the intended direction, the option buyer can sell the option at a profit. They can also exercise the option. This means they can take delivery of the underlying asset, and I'll discuss that in a moment. There are two kinds of options. We have call options, which gives the buyer the right to buy a stock at a predetermined price and at a future date. Now, most call buyers don't wait for that to happen. They simply buy a call option, hope the underlying, which is Amazon, goes up, sells the option at a profit. So in this scenario, the person buying the call is bullish on Amazon and thinks it's going up. The put option buyer gives the buyer the right to sell the stock at a predetermined price and at a future date. Now, most put buyers also don't wait for that to happen. They simply buy a put option, hope the underlying goes down, and then sell the option at a profit. In this scenario, the person buying the put is bearish on Amazon and thinks it's going down. So to easily remember the difference between call and put option, think call up, put down is probably the easiest way to visualize it. Now, here's an anatomy of an options trade. Before you execute any type of option, first you want to decide, well, are you bullish or bearish? Do you think the stock is going up or down? And that's obviously going to determine what options you buy. The expiration date, when does the option expire? Depending on the stock, it could be fairly often. Depending on what your time horizon is, that would also determine how close to expiration you want the option to be. Secondly, what is the strike price? And the strike price is the predetermined price you have the right to buy or sell the underlying stock at a future time. And the premium paid. This is the amount you pay for an option. Since the option usually represents 100 shares of the underlying stock, you multiply the price of the option by 100. Now, let's take a look at an example so you can get a visual feel for this. So right now, what you're looking at is the chart of Amazon.com, the daily chart. So each one of these bars is 1 day. Now, right now, we're trading, well, now the market is closed, but we're trading, let's just round it off to $117. Now, you might be saying, wait a minute, I thought Amazon was, $3,000 and change. It was, but a few months back, it went through something called a 20-to-1 stock split. So now, Amazon is at a steal once again, giving the opportunity for people to buy at a more affordable price. So to look at their options, Amazon's options, we go to the NASDAQ.com, which is the exchange in which the Apple is trading. So they also have their options listed there as well. Now let's assume that we think that Amazon prices are going up within the next month. It is currently September 23rd, and so let's look at the October 28th options. Now, just so you can see what I'm looking at here, this page itemizes all the options for October 21st and 28th. I'm just going to pick 28th since it's the farthest out for October. And what you see here is the call options and the put options. You see the last price, the change in price for that trading session, then the bid and ask. And now the ask is usually the price that you would pay for the option. Now, because the market is closed, in our example, we'll just use the last prices. Then you have the volume, and then you have the strike price. Okay, and then here on this side, you have the put options, and with all the same information, the last price, the change, bid and ask, volume, etc. Now you need to think, do you really think it's going to go up, right? Do you think it's going to go up, and are you willing to experience some volatility? But another question to ask is, are you willing to experience sort of faster financial moves, or are you able to wait a bit? And let's just take the faster approach. Let's say you want the option to respond more quickly to the market. What you would do is you would then buy, let's say you're buying on the upside, you think it's going to go up, you would buy the call option with the strike price closest to the current price. So the current price is 117. Go to the 117 call, and you're going to pay $7.55 per call. Now remember, each call represents 100 shares. So all you would do is 7.5 times 100, and your premium is $750. That's, not too bad, actually. Now, this is an option called at the money. And what that means is that the strike price and the current price are the same. So right now the option is at the money. And you'll see why I mentioned that in a moment. So now, for every dollar that Amazon goes up from this point, you make $1 on your option, so $100. So if Amazon were to shoot up to 130, right, you would make on your option, let's do this, 130 minus 117, 13 points times 100 times 100. You would make $1,300. And the thing is that you would also make $1,300 if you had actually purchased 100 shares of Amazon. So you could see you have some flexibility here. Now you have two things you can do here. You can, let's just say Amazon is at 130. You can now sell the option at a profit, which is what most people do before the expiration of October 28th. Or when the option does expire, you exercise the option. So what happens then is that you buy, even if the market is at 130, you have the right to buy 100 shares at $117 a share. And then you can resell it, and you would make that profit between 117 and 130, or you can just simply hold on to the stock. Now, the disadvantage of exercising the option is that you're going to have to come up with the money to buy 100 shares at $117 a share. Whereas with the option, all you had to pay was $750. Now, there's obviously a catch. The option, if nothing happens, if let's just say Amazon doesn't go up and it sort of stays where it is, like let's say in this example, it sort of stays in this choppy area, your option is going to expire worthless if you don't sell it before the expiration. Or if Amazon drops, then your option will be worth almost nothing. Because if Amazon drops from 117 to, let's just say 110 or 108 or something, you could lose almost all this money, and then you can either hold on to it until expiration because it's going to expire worthless anyway. So that is one way if you want to really be part of the movement for Amazon. You can buy the at the money call option. Now, if you're willing to be a little bit more patient, you can buy a call option for another strike price. Let's just say 129. Now, the 129 call is pretty far away. The 129 strike price, that's all the way up here, okay? And so because it's so far away, this option is called out of the money. Now, the one benefit of the out of the money call is that it's significantly cheaper. So it's only $2.71 per option, so you would be paying $271 for the call. Now, if the Amazon never reaches 129, your option will expire worthless. Now, if let's say it goes to, let's say 122, 123, the value of your 129 call will also go up, even if it never hits 129. And so you can, sell the option at a profit if you wanted to. So that's one way to do this. So then it would be you would get an out of the money call in this case. Now, if you're willing to pay more money and you want really fast action, you can buy a call that is under the current market price. So you can buy, let's say, like a 110 call. Now, because now that the Amazon is at 117, the 110 call is very much in the money. It's 7 points in the money. So you're going to pay $1,262 for this call, but for every dollar that Amazon goes up, you are making at least $1 on it, so $100. So that's also one way you can do it. But again, if you buy in the money calls like these, they're significantly more expensive. So as you can see, the market is at 117. So all the options under 117, look at how expensive they are. And then as they go out of the money, look at how cheap they become. So it's important to figure out your strategy going forward to see how you want to do this. Now, I know that sounds great. Instead of paying, $11,700 for 100 shares of Amazon, just go in for, $750 call. But again, remember, you are subject to a wasting asset. If the call expires worthless, you lose that $750. So that's just something to keep in mind. Now, we have also the inverse, where you can, if you think that Amazon is going to go down, and then you would be focused on the put options. So again, you would need to think, how far do you think Amazon is going to go down? Because right now, Amazon is in pretty much a downtrend. We had these bounces here. And as of Friday, the 22nd, we are down the market, and the pre-market is down $2 from there. But we're just going to assume the closing price is about 117 right now. So what you could do is, again, buy a 117 put, and then you would have an at-the-money put option for $660. And as you can see, because the market was down, it's actually up in value. You made $40 yesterday if you had purchased this the day before. So you have that option of buying at-the-money put. Now, if the Amazon stock drops to 110, okay, so now your put is $7 in the money, okay? You can sell the option, you can sell the put option at a profit, or you can exercise the option at expiration. And what would happen here is you would immediately be short Amazon from 117, which would be great because, if Amazon is at 110, you can cover your short and keep that $700 profit, or you can just stay short the market and just let it ride. So that's also an option you can take. So this was just a rough idea of how these work. I gave you more examples on the call options because actually call options are very popular, but I just wanted you to get an idea of how the dynamics work. And and the dynamic for the put options is the same as the call options. But if I kept on going, we would be here for hours, So I think that options are a great tool, but there's a catch. They expire worthless if the market doesn't move in your favor or it doesn't move at all. It just sort of stays in a range. So, but of course, they're also beneficial because the option allows you to get into the market where you may not have had the budget to get into in the first place. Like, you may not have $11,700 to buy 100 shares of Amazon, but you have $750 to buy the call option, or $660 to buy the put option. So it offers you more flexibility. And in some scenarios, trading options is better than actually trading the underlying stock. But that's a little bit more advanced because options go way beyond just buying them. You can sell them as well and add them to all of these strategies, but that's really too advanced for this particular topic, for this podcast. But I could create a course on it if you'd like. Just send me an email. So there you have it. I know it seems a bit confusing since it's not exactly an intuitive thing, but I hope you understand them a bit better. If you have any questions, feel free to contact me. Now we're going to go to Trader's Corner. See you then. So if you recall in the last podcast, I was expecting in Solana what they called a dead cat bounce. And by the way, I'm going to stop using that term. I'm just going to say a bounce because dead cat sort of sounds a little horrible. So, and that was here, and I was right. And I got out before I got a signal to get out. And it hit here, which is just sort of tracking the trend, and then it bounced back down, just like I said it was going to happen. So I got out a little early, but that's okay. I'm okay giving up, a point and a half in profit. I took this whole move down, so I'm not worried about it. Now, here we have another quote-unquote bounce, and then it started to come down again here. Now, why didn't I sell here? I didn't because we were already oversold. So I was like, no, this is not going to last. I mean, it's going to happen, but it's not going to last. And so I did not do so. And now that we're back up into this bounce area, now it's safer to get in. But this time, I did not short sell Solana. What I did is I short sold Ethereum. And this is the Ethereum chart. And the reason why I did that, and you see the bounces, these are also called corrections, by the way. The reason why I is because it has a better range. And when you're trading, really the things you want to look at are range and volatility, because you're trading. If you're investing, volatility is not your friend. But when you're trading, and like in this case, and this is the 3-hour chart just like in the previous week, but Ethereum, you want some range. So like what's beautiful about Ethereum is that, one bar could be, $100, 1 3-hour bar. So what I did is I short sold 15 Ethereum at 14.29, I believe it is. And I used 2x margin, and we are now at 13.91. So this has already been a profitable trade for me, and I'm going to stay in. And this time I will stay in until we get another take profit signal, and that could be in the next few days. It could be in the next few hours. And when that does happen, I will record that. I don't know if it'll be in this particular podcast. It might, because now I'm pre-recording this. This is actually Sunday of the same week I sent you the other podcast. So Sunday, the 18th of September. So I am now short, and we'll see what happens with Ethereum, because I think that it still has some room to go down. We still have a lot of downward pressure, and once it cuts down to this level, then I'll wait for this take profit signal, and then I will take profit and maybe even reverse my position and go long. So right now, short 15, use 2x margin, and we'll see what happens. Now, because I am pre-recording this on Sunday, and this will be inserted into the podcast, there might be other trades I'm looking at, and I'll insert those too. So if all of a sudden you see me break away from one thing to another and it seems almost inconsistent, it's because I'm recording them at different times. And again, if you're interested in the indicators that I'm using, just go to blockchainimmersive.com/Mr. Z, and you can find these indicators. And like I said in the previous podcast, what's great about these indicators is that everything that I was already doing, I was doing a little bit more manually, and I found a system that actually allowed me to just program it right here, and I don't have to do it as manually. And it's great. It's worth every penny, and it's already paid for itself. I mean, although I've had this already for a few months, but I mean, just this trade alone, right? I mean, I paid, how many years of this service, you know what I mean? So it's definitely worth looking into. So that's it for this particular trade. Again, it is possible that there will be another trade video, but I really wanted to record this now as it's happening, because I just think it's really important for you to see what I'm doing, because it's a lot of these traders and a lot of these services, they talk a good game. They talk about hypothetical things. You're like, oh, you would have gone short here and then you would have bought here. But the things that they're not showing you the real thing, like they're not showing you, look, you put real money down on this thing. They said, oh, if you did, you would have. No. As you saw in my courses, in all my courses, the one on NFT, the general one, trader psychology, the one on technical analysis, I am taking trades right there for you to see. And I put my money where my mouth is. I think it's important because anyone can teach anything. Right? You could just look up something, boom, write a couple of notes, and all of a sudden everyone's teaching something. But in my case, and as you know from my other courses in my spirituality, I show you like this, how it, with my own essence, you know what I mean? And so I think that is very important. So I'm going to end this particular video. Again, there might be another video. I'll keep you posted, obviously, when that happens. All right, here's an update from September 19th, 5:23 a.m. I just got a signal to get out of the Ethereum short trade, and that turned out to be a really successful trade. So let's see what we got here. I got in at 1429.60, got out at 12.91. It's $138.60 per token times 15 tokens, $2,079 profit in not even a full 24 hours. And that was sort of how it was with the Solana too. But as you saw, the range for Ethereum is much better. So you see, in one day, this thing dropped $138, whereas Solana dropped 3 points. So, and you need to get a lot more of Solana to make that worth your while. So this was a good trade. This was a great example. Again, a little bit more live for you now, because before I wanted to produce the podcast. So now you see it. And so I'm going to see what happens here. It's possible there's going to be a bounce, as you see, and if there's a signal to buy that bounce, I will. But if there isn't, I'll just wait and see if it reaches this upper band, and then I'll short sell again. Or there might be a full buy signal, and I'll just go long. So we'll see what happens. Now, I did want to mention that if you are not risk averse, you could potentially see another trade here on the upside. Is what you would do is, you see, because we're in this very oversold region, is that when one of these bars turns green, you would then go long, even though you don't technically have a buy signal, because you're betting that it'll eventually come and at least meet the red line as this market is moving. So it's very risky, and I'm not telling you to do that, but that's something that I would consider if I did see that. And we sort of saw what happened here when it started going green. It came, hit this, and then came down, hit it again. So I mean, if you're really want to hit this market, obviously you could always play this move to the red line, and if it exceeds the red line, the system will generate a buy signal. And so you have two options. You can just stay in to the buy to the trade you took, or you add to the position. And for me personally, if I were to take a bounce here, and I would buy it at the next green line with the assumption that it's coming to at least meet the red line. If it exceeds the line and a buy signal is actually triggered, I would add to the position myself. So that's how I would have played this, and I potentially will play it like that. I'm gonna watch the market today. The market is a little jittery because the Fed will eventually give some type of guidance this week as to interest rates. So we just want to you want to be careful with those, because even if it's news that is beneficial for the cryptocurrencies, the volatility can increase so much that you could be pushed out of the market even if you're in the right direction, because the swings will be so wide that, let's say you have a $200 stop loss, right? You don't want to risk more than $200 on a trade to the upside. You might still be right about the market, but because the market is so reactive to the news, it might hit your $200 stop loss and you'll get stopped out with your $200 loss. And then within minutes, it comes shooting back up as you expected. So that's why trading news is extremely dangerous unless you have a high risk tolerance. As I've said in my courses, I have a very high risk tolerance. So for me, I realize that the market's going to be emotional like that. And so it's, I sort of just stay the course unless I get a very clear signal that I need to either reverse my position or get out of my current one. And that would be what these indicators will tell me. That if it tells me, okay, a buy signal was generated, I might take it. Or what I might do is just wait a few minutes to let the market sort of process the news and then regroup from there. So, it's just something. And again, I'm not a financial advisor. I'm not telling you to do this. I'm just showing you different types of scenarios that could play out in the future. So I'm keeping my eye on Ethereum. I'm going to keep my eye on it like a hawk, and I might do that risky trade is when I see the next green bar. I might take that trade to at least meet the red line. If not, sometimes it could stall out right here and then come back down. So I'm going to see how the market is, and I'll create a secondary video to it. Okay, so I just got my first green line here, and I went long 10 Ethereum, 1x margin. I got in at 1317 points, and the reason why I only went in 10 as opposed to 15 is because this is a more speculative trade. I'm betting that because we're so oversold that we're going to try to get up to this red line, and once it shows weakness, if it's going to come back down, then I'll sell it and maybe even reverse my position. Now, this is incredibly risky, right? Because this could continue to go down, so I'm going to monitor it, but I'm betting on that there's going to be a bounce, at least try to regain some of this ground here. Now, if we hit this line and it starts going up, a buy signal will be generated, and once that happens, I will then buy another 10 and use 2x margin and then just ride it for as long as I can. So remember, this is a very risky trade. All of these trades that are not officially recognized by the system is definitely risky. Not that they're not always risky, but this is a little bit more risky because I'm literally trading counter trend. And that's always a dangerous bet. But we'll see how this resolves, and I'll create another video in either case within the next few hours. Hello friends. Okay, so we are only, we were just an hour or two from when I got in. Remember I told you that I was expecting a bounce, and we have got this bounce. Remember, I got in at 1317. We are now at 1361, and we are approaching this upper band here, which is 1388, which is nothing for Ethereum to go through. So as you know from the previous video, I have 10 Ethereum 1x leverage, and the reason I did the 1x again is because this was a very dangerous trade to get into because it was very counter trend. But right now it's doing very well. So I'm going to wait and see. We are at the bottom range here, so we have a lot of room to move up. So I'm suspecting, I could be wrong, I'm suspecting we are going to penetrate this red line and a buy signal will be generated, and I will go in at additional 10 Ethereum, but this time with 2x leverage, so for a total of 20 Ethereum. Now, of course, that is risky. Again, when you're using leverage, it's risky, but like I said in my courses, you know, anything above 5 is pretty risky. 5 is the top. Anyone who's doing 10 is insane. So, you know, could I do it? I mean, obviously, if I had done it in any of these trades, obviously my profits would magnify by 10. But as I said in my Psychology of Trading course, greed is your #1 enemy. Really, I mean, that will kill you. So that's why it's best to have a moderate approach and just take it from there. So we'll see what happens here. It looks very promising, but you know, the market is a fickle thing. I mean, we could stall out right here and it comes right back down. But I have a feeling we're going to at least touch this red area, and once we do, that's when I'm going to be pretty much watching the market, and I'm just going to put in like alerts at different levels to just so the system lets me know. Because let's say I'm stepped away for a moment, and let's say it goes up to 1390. Actually, I could just put an alert right now in Trading View right now. Put an alert at 1390, and you see right here it opens up, and these are all my alerts right now. And so once it hits there, it's going to let me know, and then I'm going to be like, okay, we hit the red line. Now it's time to, you know, really watch this. Will it hit the red line in reverse, or will it penetrate the red line, and then we have a buy signal? So I'll keep you posted on this trade, and whatever happens with this trade, it'll be the last one for this newsletter, only because I don't want the whole newsletter to just be about trades, because this isn't a you know, a trading advisory, right? So I'm not, you know, this is not a service that I'm telling you, oh, I'm doing this, doing that. I'm just showing you what I look at on a daily basis, so you get an idea. Now, again, because I'm mostly dealing with cryptos here, that's all I'm showing you. I have trades in other markets as well. So, and I'll probably cover those later at another time. But that's it for this moment, and I will let you know how this trade evolves, win, lose, or draw. Hello, friends. So if you remember yesterday, I got in long from this bounce, and look at that. It hit that line and then bounced right back. So I got out at 1336. I got in at, what was it, 1317 or so. And so I made about like $190 on the trade. And what I did is I went short. Okay, I went short immediately after because clearly it's bouncing off here. this indicator is now sort of in this null zone, because usually if it's up top or low, it's, overbought, oversold, and we were correct here in catching this bounce. So I didn't get as much as I wanted out of this trade, but I got something, and that's what counts. I mean, if you can break even or just make a little bit of money, you are in the game. So I am now short 10 Ethereum, 1x leverage. I'm being a little more cautious here because tomorrow we have the Federal Reserve meeting about interest rates, and that's going to be a volatile session. So we'll see what happens. But this is the last. I'm not going to update you on this current short, because if we do this, we're going to, you're going to have like 20 trades in this podcast. You know what I mean? So anyway, but overall, we've had very successful trades in this particular podcast session, and the next, the following podcast, I'll have other trades for you. So I'm probably going to stick with Ethereum, but that could change. I might do Bitcoin. We'll see how the market plays out. Well, I said that I was not going to discuss the summation of this last trade, but I had to. I had to, because it turned out to be a very good trade, and I'm still in it. And if you remember, we bounced off this, and then I short sold. And we didn't close above the red line, so a buy trigger did not enter the market. So I'm still short this market, and it's a really profitable trade because you can see this big day down, and that was because of the inflation report that came out yesterday. And remember, this is 3 hours. Each bar is 3 hours, so this was yesterday, and so that was is very much in my favor. We're now in a sort of holding pattern here. I don't know what's going to happen, but I'm going to look to get out if I have to, hopefully to retain a lot of this profit, because I went short from, around this area here. So it's still below, which is great. And that's it for Trader's Corner, and that's it for this podcast. My goodness, it was much longer than I anticipated, which is good. I mean, that means you got a lot of good information here. So I will be back at the next podcast, and I'll cover the news and any interesting trades of the week, which could be the summation of this current trade, and then the reversal and going in the opposite direction. I don't know. And we'll discuss next week the foreign exchange market as an added information for you. So then you can see what other options, what other things that I trade, and what other things are tradable. And the foreign exchange is definitely a market to know. Until then, I will speak to you soon.